Hi, today we are going to talk about option Greeks. Recall in the last lecture we spoke about the option pricing, whereby we introduced several parameters that goes into option pricing, and they are namely the option price, the current stock price, time to maturity T, implied vol, sigma, risk-free, R, and strike K. Today we want to talk about option Greeks. Basically, it essentially means that what happens when all these underlying changes and what's the impact on the option price. The Greeks that we're going to talk about are the delta gamma, which is referring to the changes in the spot price on the option price, the theta, vega, and the rho. There's no Greek for strike because strike doesn't change. Okay, and the way that I'm going to talk about the Greeks in this lecture is not to introduce formulas or to go through any mathematics. It's just an introduction on the intuition of these Greeks and the diagrams of the Greeks when there's a put and a call option that is being traded. Okay, let's look at the typical call option, equity call option. Let's assume that we have bought a call option and at the strike S. Okay, at strike K, and the current spot is S. Imagine that we want to hedge this option and we have at our disposal equity. Okay, we can only hedge using equities. So clearly, because this is a long call option, our exposure is we are exposed to a long equity risk. Meaning that when equity price rise, okay, we make money from this option, and vice versa. When it falls, we lose money. So to hedge this option, we should short the underlying. So when we short, right, when equity price rise, we lose money, and equity price fall, we make money. So we are kind of knock off against our P&L in the option. Assuming that we short one share, okay, we short one share. The payoff for the one share will be shown as such, and this is a 45 degree. Okay, because it's one share, every time it moves 1 unit on the x-axis, we lose $1. When it moves 1 unit to the left, meaning the underlying falls by $1, we make $1 on the share. Okay, so assuming that we short one share, let's look at whether we are really hedged or not. If price moves to say assuming equity price moves to say S1, let's look at how much we make from the option. Okay, we are actually making, I mean, it's just a rough estimation, making this much. Not much, this much, okay? So this is the P&L from the option. But how much do we lose from the share? Okay, we are losing this much. This, let's say it cuts here, right? Cuts here. We are losing this much. So clearly, shorting one share is not the right answer. Okay, we should short a bit lesser, but the question is how much. That's where the concept of delta comes in. Delta is represented by a Greek symbol triangle sign, and is being denoted by the formula change in the price of the option over change in the spot. Okay, so this is basically the gradient as at the point S. Let me draw the gradient. It's something like that. So difficult to draw. Okay, so this is a gradient as a point S. Assume that so instead of actually shorting one lot of equity as an S, let's try shorting the delta of the option as an S of the equity. Okay, let's do that and see what's the impact. Instead of shorting one lot, we short delta lots. Okay, so delta lots will be something like, it's much more flattish already. Something like that. Okay, so this much profit is basically the inverse of what we see here, because we are shorting the share. Okay, so let's go back to the example that we have just now. When the price moves to S1, okay, we are making this much from the option. But now, because now we are short the delta lots of the underlying, we are losing this much. Okay, basically it's the same magnitude as what we, well, almost the same magnitude as what we gain in the option. So that explains why delta is sort of the hedging ratio. And when people say when the delta hedge, we just hedge the number of units that delta returns us. And delta is the gradient of the option price diagram. Okay. But of course, as for small movement in the spot, it's a good hedge. But we shall see later that when it's a larger movement, it's not a good hedge, because okay, let's again imagine that the price moves to S2. Okay, so assume that we keep this hedge for the period where from S to S2, and we would have lost, say, we would have lost this amount. Okay, this amount. But for the option, look at the option, how much have we gained? We have gained this amount. So you can see that the magnitude of the movements are not the same. We have gained more from the option than we have lost from the underlying. So this basically just tells us that delta is not static. There's a need to constantly rebalance delta. Imagine had we at S3, right? We do a rebalancing. Delta here is something like, let me use another color. Delta here is something like that. Certainly steeper than what we have here, which means that there's a need to sell more shares. Okay, so assume that delta here is, say, 0.3. Assume delta here is 0.7. So from 0.3 to 0.7 is basically 0.4 more. So we've got to sell 0.4 more units of shares when S moves from S to S3. Have we done that? When S subsequently moves from S3 to S2, the movement here will be much more equal to the movement in the underlying share price. So a 0.7 hedge here will be equivalent to this. Okay, so movement from S3 to S2, right, will be much more equal. So from S3 to S2, the loss from the share is of this magnitude, and the gain from the option is of this magnitude. So it's much more equivalent, and it's a much better hedge. And from the example, we see that there's a need to constantly hedge constantly rebalance our hedge when S moves. Okay. Again, I did not show the example of what happens when S moves down, but I think intuitively you should know when S, say, moves to S4 here, delta has become even a smaller number. So let's say this is 0.1. Okay, so from, say, 0.7 or 0.3, right, back to 0.1, there's a need to actually buy back the shares we have sold here. So we have sold, say, 0.3 here, right? We have sold 0.7 here. But now data tells us that it's only 0.1 here, so we should sell some shares that we have. Okay, so from this example, we can see that we are actually selling when the price is high, and we are buying back the shares when the price is low. So this is the example of buy low, sell high. Okay, which in all trading of any financial asset, this is a good strategy to have. You buy low, you sell high, you make money. Okay, so through the concept of delta hedging, we can actually make money for when we are hedging a buy call option, which incidentally is to offset the premium that we pay. Okay. So back to the concept of delta. Okay, so we can see the delta is essentially the gradient of the curve, and gradient will range from around here. It should be flattish, and so it should be 0. Okay, so delta will range from 0 around here all the way to here, and because it's being close, it will be tending to a 45 degree line, so delta will tend to 1. So maximum delta will be 1. So delta will be a number between this range. Second point to note is that when it's at k, right, delta is at sort of the inflection point. We don't know whether we will make money or we will lose money, so we kind of sit on the fence. So when at point equal to k, delta is 0.5. Okay, sort of sit on the fence. Okay, so based on these rules, we can now go on to plot the delta diagram. Okay, I've drawn 4 charts here, 4 payoff charts, which represent a buy call, sell call, buy put, sell put option. Okay, so we know that delta is the gradient of the option premium. So if you look at the buy call graph, okay, it's a positive gradient graph. So intuitively we know that delta is in this direction. Okay, so at this point, when it's out of the money, right, the delta is flattish, so it should be 0 at around 0 here. At this point, when it's in the money, it should be at 1 here. Okay, at k, it should be 0.5. So we know that the graph will look something like that. Okay, so that's the diagram for the delta for a buy call, and for a sell call, the diagram will look something like that. Okay, so you just infer from this diagram. Suddenly it will be negative because the slope of any point here is a negative slope, and when it's close, when it's very out of the money, it's 0. When it's very in the money, it's 1. Okay, so it's something like that. And if you just along the lines of what I said earlier, the delta for the sell put will be something like that. Okay, sorry, the buy put something like that, and the sell put will look something like that. Okay, so this 1, this 0, and then k here, and this will be 0.5. Okay, they're all the same concept, so you can intuitively draw the diagrams of the delta using what I've mentioned earlier. Okay, let's now introduce the concept of gamma. Gamma is measuring the curvature of the payoff diagram. As you can imagine here, as I've shown here, there's no way we can hedge option with underlying equity in an exact manner, mainly because we can see from here that the option is being influenced by so many factors: spot, the time to maturity, sigma, risk-free, and strike. But the equity itself, there's no concept of volatility. Okay, there's no time to maturity, so only the spot matters for equity. So there's no way of really hedging an option exactly when we are using equities, and this is clearly so shown here. Even if spot moves from S to S1, right, and this is our hedge for equity, there's a bit of a curvature here, and it's not exact price movement. Okay, so that's why there's this concept called the gamma, which is actually measuring the curvature of the option price diagram. And gamma is being represented by the Greek symbol like that. And this is the change in delta over change in spot. Okay, if I write it in another form, delta is dp over ds. Okay, so this is actually the second derivative of the call option price, okay, over spot. Second derivative. So let's try to imagine that there's another call option that looks like that. Okay, if you compare the first call option versus the second call option, in the second call option it looks a bit less curved than the first call option. Okay, when we look at the delta of the second call option, this delta at this point is like that. Okay, at this point is like that. At this point is like that. Delta at practically any spot is more or less the same, and is in a way, which means that the second derivative of delta, which is the gamma, is very low. There's really not much to rehedge when spot moves. Okay, so the delta is always the same, more or less the same. And as opposed to the first example, where delta changes when spot moves, and which means that the gamma for the first example is high, and we have to rehedge frequently. Okay, let's look at how the gamma curve looks like. Next time we draw the delta curve. Gamma curve is given by the change in delta over change in spot. Okay, so this diagram of a delta, this delta diagram, right? X-axis is S, the y-axis is delta. So clearly, change in delta of change in spot is simply the gradient of this curve, the delta curve. And we can see that at this point is flattish, so the gradient should be close to 0. Okay, at these 2 points. And gradient at this point is the steepest, so it should be somewhere here. So the gamma curve will look something like that. Sorry. Okay. Alright, and let's move on to a short call. This is flattish, this is flattish, this is maximum. But if you compare these two, right, this is a negative gamma because the slope here is negative. So it should be something like that. Okay, and this one again, I'll move quickly. This is a positive gamma, so this will be something like that. And this is a negative gamma, something like that. Okay, and of course the max is at K. So from this diagram we can see that whenever we are long an option, gamma is always positive. When we are short an option, gamma is always negative. Okay. Next, I want to talk about the concept of the theta. Okay, theta is represented by the Greek symbol like that. Okay, so this is basically a change in the price of the option over change in the price of the time to maturity. So basically, you just say for every day, how much is the time decay when option gets closer to maturity. Let's go back. Let's start from the payoff diagram. Okay, you remember, you notice that for any explanation, I always start with the option payoff diagram. Okay, so let's look at the payoff diagram of buy call option. At expiration, we have this diagram, a 45-degree line represented in yellow. Okay, so per unit spot movement over K, we have 1 unit of the P&L when it expires. And before expiry, the option diagram, premium is being represented by this white line, assume that we are still 6 months to maturity. The one line is represented here, and it's close to the payoff diagram when it's far in the money, and it's close to the x-axis when it's far out of the money. So what theta means is, as time passes, we can see that this white line will slowly move towards the expiration payoff diagram in this manner. So over time, this will move in this direction. Basically, why is this so? Intuitively, we can think of it as when we need time for the option we need time for the underlying to move. So given more time, there's high chance that spot will move above K, and hence we will be in the money given enough time. Assume that we are 1 day away and currently spot is here. Okay, so the option premium wouldn't be so far above x-axis. It will be somewhere here, okay, somewhere nearer to the x-axis. So as you can see, over time, we option premium graph line will slowly move towards the payoff line in yellow. So from this graph, we can also tell another thing: the distance from the option premium line to the payoff line as a K this distance is much larger than the distance that is out of the money and is in the money. Okay. So given the same time that this line has to move towards the yellow line, at the money option, the movement needs to be larger than the movement here, and hence it explains why the theta for options at the money is the highest. Okay, when we represent theta, we always represent it in a negative format, because for buy call, right, we are losing theta over time. We are losing the P&L over time, assuming everything else is equal. So for at the money option, it should be the highest. Let's try to draw the theta diagram with respect to the spot. Therefore, at the money option, it should be highest, while in the money and out of the money options, it should be lowest. Okay, so the diagram will be represented something like that, or the theta diagram. Okay, notice that this is very similar to the gamma diagram. Gamma, let me show you gamma. Okay, gamma diagram is like that. Theta is something like that. So we can intuitively see that theta is actually in a way the inverse of the gamma. And intuition, we can also make a guess why, because we need volatility to make money, and but volatility is also a function of time. We need a lot of time to have a lot of volatility. Okay, so these two, the gamma and the theta, is actually inverse of one another, and this can be easily shown using the Black-Scholes formula, but I'm not going to do it today. Alright, let's back to the theta diagram. Another way of showing the theta diagram is using the time value. We know that the option price is made of two components. Okay, this is the time value, and this is the intrinsic value. So this time value is actually what causes theta, because over time you can see the time value slowly move down. Okay, so this is the rate of change of the option premium that we want to measure, and we can draw this little time value using the chart that shows that has the time to maturity on the x-axis time value of the option on the y-axis. Okay, why I want to do time value here and the time to maturity here? Because I want to have P on the x-axis and P on the y-axis. Well, this is not exactly P because this is only measuring the time value. The entire P is comprised of this time value and the intrinsic value, but it doesn't matter because we want to take the gradient. Okay, so when we draw a time value versus maturity, let's do it in an intuitive manner as well. When we have a long time to maturity, say we have 6 months to maturity, the time value is the longest. Okay, because that's how we agree that over time this will move towards K. Okay, so this one, when there's a long time to maturity, it should be highest. And when it's nearing maturity, you move towards K. Okay, maturity is 0 here. Let's say we have 6 months here. Okay, it will move something like that. The graph looks something like that. Time value actually falls when we are moving towards maturity. Some people switch the axis so that 0 is here and 6 months is here. Well, I'm representing this like that. It's the same thing. Okay, so from this diagram we can see that if we want to obtain dp over dt, right, it's actually the gradient of the time value versus time to maturity graph. Okay, so let me draw the theta. So this is again the time to maturity. So we can see that theta graph will look something like that. I'm taking the gradient of this graph. Okay. Normally people will represent theta in a negative manner. So if you want to draw it in a negative form, it will look something like that. It's the same thing. Okay. Another point to note is, let's talk about another point that we can discuss here is the concept of at the money option versus in the money option. If you look at this region, right, again, let's look at this graph. When option is at the money, we have agreed that the distance to move for the option value is the largest. Okay, so we can represent the time value in this graph by drawing the different types of options here. So assume this at the money option is the largest, represented by 6 months, right? Yeah. Let's say this is X. Okay. Let's look at another option which is way in the money. This will be much smaller as compared to an option which is in the money. So in the money option will be somewhere. In the money option will be certainly lower than at the money option. It will look something like that. Okay, and continuing the same discussion we have, let's look at the out of the money option. It's also certainly lesser than at the money option. It will look something like that. Okay, so if we draw the graph of theta against time to maturity for these two other options as well, in the money and the money, it will be lower than the theta at the money option. Okay, so because these are flatter, right, the gradient is lower than at the money option. So this will be the in the money option, and this is the out of the money option. So this is out of the money option. If you inverse it, it will be lower somewhere around here. Okay, so that's in summary the concept of theta. That's all I want to talk about theta here. Let's move on to vega. With vega, what is vega? Vega is represented by the Greek notation V, and this is the change in the option price over change in volatility. Okay, let's look at this again. We start off from a basic call option. This is the call option payoff diagram. We look at this point. Okay, when the spot is at this point, any volatility is certainly going to move the option by a lot, because one moment you are in the money, one moment you are out of money. So you can imagine that volatility here will influence the option price by the most. So we have largest vega at this point. Okay, imagine that you are at this point and the option is really more or less worthless. Even if the price is very volatile here, the option is still worthless and eventually you will expire out of money, unless there's super huge volatility that will move the price above K. So you can imagine that the vega at this point is really close to zero at this point here. And conversely, when you are way in the money, say at this point, right, it really takes a lot of movement for you to for the underlying price to move below K. Okay? So similarly, the vega at this point is also very low. This here. So the vega payoff diagram, the vega diagram against spot looks something like that. Okay, and imagine that you compare two options. Everything is the same except the time to maturity. One is say 6 months to maturity, and one is say 1 day to maturity. Which vega do you think is higher? Clearly, it will be a longer maturity option because you have so much time to go before it matures. And there's a lot of chances that you will become in the money or you will make a lot of profits out of it. So a vega for a longer maturity option will be always sitting above the shorter maturity option. So let's say this is 6 months. Okay, so the second one is T equal to say 1 week. Okay. Yeah, so that's about all for vega that I want to talk about. Lastly, let's move on to rho. Rho is basically measuring the change in price in relation to change in the risk-free rate. Okay, remember, let me draw the payoff diagram. Remember when we talk about delta, when we are long a call option, we hedge the delta by selling shares. Okay? When we sell shares, we are shorting the shares, we get the cash, and what do we do with the cash? We can deposit in a bank and earn interest. So you can imagine that when we do that, when we long a call option and we deposit the cash, we earn money. So actually, when we long a call, we are making money from the interest rates. So rule for a long call will always be positive. Okay? When spot moves higher, we are shorting more. Okay, so growth for a long call is always positively sloped line, and the longer the maturity, we can deposit in the bank for longer periods. So we can intuitively say that rho is always larger or higher, longer maturity. Okay, so say this is 6 months. So this is say 1 month. These are for long call options. Similarly, if you put yourself in a situation whereby you buy a put, so in this situation, you have to buy shares in order to hedge the put option. When you do that, you are actually borrowing money to buy the shares. So interest rate will work against you, which explains why for a put option, the rho is always negative, and it will look something like that. The higher the price, the more you need to borrow, and you bring down the value of the premium, option premium, which explains why this is a negative graph. Okay, That's all I want to say about Greeks